Assalamu alaikum to all of you, and a very good evening to all the participants of the practice to pass session. Today is day 3, and in the last 2 days we have covered the topic consolidated balance sheet and consolidated income statement. So there is a single topic that is left over, that is related to the gain or loss and disposal and some interpretation of the consolidated financial statements, and then we will start the new topic, that is final accounts today. So the gains and losses on disposal. So it happens when the parent company sold goods to the subsidiary company. Sorry, when the parent company sold shares of the subsidiary company to the other members, and sometimes they still will be able to maintain the control, and sometimes they lost the control. So in all the cases, you need to recognize the gain or loss and disposal. So this is the only thing that is examinable at this stage. Actually, there is a huge, it's a huge topic, disposal, in which we'll be having 4 to 5 types of different cases. But with reference to F7, only the calculation of the gains and loss on disposal is the part of the course. So when the parent company, assuming the parent company has got 80% shares of subsidiary company, and then subsequently sold out all its investment in the subsidiary company. So there are 2 types of gains that can happen. The first thing is related to the individual financial statements. So in the individual financial statement of the parent company, there could be a gain that or loss that you need to recognize, but with respect to the parent company. And there could be a situation where you need to calculate the gain or loss with respect to the group. So there might be 2 types of gain. The first one is related to the parent company's individual financial statements, and the second thing is with respect to the group accounts. So we need to see if the situation occurs of the disposal. In the disposal case, with respect to the parent company's individual financial statements, the gain or loss will be calculated with this formula. Sale proceeds mean the price at which we have sold the shares and the carrying amount of this investment. Carrying amount means the book value of the investment that is shown in the parent company's assets. And the difference between these 2 figures will be the gains and loss on disposal. So this is with respect to the individual financial statements. With respect to the consolidated financial statements, you need to work on the sale proceeds, less these all items will be deducted. Net assets at the disposal plus goodwill at disposal and non-controlling interest at disposal. So the answer for this figure should be deducted from the sale proceeds, and you will get the answer of gain or loss on disposal. So the formatting of this PPT is a little bit confusing. So first you need to show the sale proceeds, the value at which we have sold the investment, and then net assets at disposal, goodwill at disposal, and NC at disposal. So this will be the adjusted figure, and the difference between these 2 amounts will be the gain or loss on disposal. So this is the formula. Is the investment to acquire the subsidy? Yes. So we have got 2 formulas. The first one is related to the individual financial statements, and the second one is related with reference to the group accounts. So the requirement of this question is calculate the profit or loss on disposal profit after tax and disposal of subsidiary company to be shown in the parent's individual financial statements and parent subsidiary consolidated financial statements. So these are the two things. So I want all of you guys to calculate the gain or loss on disposal in this question. Okay, is it done? Wonderful. So first we are going to solve the question, Paul, to calculate the gain or loss on disposal in the Paul's individual financial statements. So Paul has acquired an 80% interest in subsidiary for 6 million. So this is the initial investment that we have made in the shares. At which date the subsidiary net asset at a fair value of 5 million and the fair value of the non-controlling interest 1.2 billion. At 30th June 2006, Paul sold lots of its shares in 7 for 8 million. So you have acquired it for 6 million and sold it for 8 million. So there will be a gain on disposal of 2 million. That's very simple. Goodwill has been impaired by 1 million by the date of disposal. Paul values the non-controlling using a fair value method. Tax on the profits is charged at 30%. So with respect to the group's point of view, so first you need to take the value at which you have sold the asset. So this will be the cash received amount. Investment in associate is 6 million and its return is 8 million. So there will be a gain of 2 million. That must be recognized in the individual financial statements. Now with respect to the group accounts, first you need to do the cash received during the year, that is 8 million, less net assets at disposal. So at 30th June, sold all of its for 8 million. At this date, the fair value of net asset was 7 million. Goodwill at the date of acquisition was valued at 2.2 million and which has been impaired by 1 million during the year. So goodwill at the reporting date will be 1.2 million. And then you need to deduct the fair value of net assets, NCI disposal. NCI disposal will be calculated as NCI acquisition is 1.2 million, and in the post acquisition period you need to calculate the NCI figure actually here. NCI acquisition 1.2 million. In the post acquisition period, they have earned a profit of 7 million out of 5 million. To 20%. So it will be 0.2 less impairment loss of 1 million ka 20%, 0.2. So 1.4 will be the amount of NCI. So by adding these values, we got the value of, I think it's not fair. Need to solve it on the scratch pad. Cash received is 8 million less net assets at disposal will be 7 million plus goodwill will be 2.2 or NCI will be 1.4. So 7 plus 2.2 will be 7.8. There will be a gain of 0.2. Okay, but actually goodwill all has suffered an impairment. If I'm not wrong, 1 million on disposal. It was actually -1. So 6.2, 1.2. Explain NCI. How was the goodwill calculation? First, we need to calculate the goodwill. The cost of investment is 6 million. NCI acquisition is 1.2. Subsidiary companies less fair value of net assets at the date of acquisition will be 5 million. Is it clear? Goodwill. Talking about the NCI. NCI acquisition will be 1.2. Subsidiaries post acquisition profit will be 2 million into 20%. That will be 0.4 less impairment loss 0.2 and it will be 1.4. Is it clear now? Are such questions only likely to be in section A and B? Yes. It could be the part of section C, but in the ratios question only. Yes, 1 million into 20% will go in the income statement, in the NCI. Is it clear? Yes. If it was parent SOPL, we would Take 80%. 80% for the impairment loss. No, we charge a full amount in the income statement first, and then we adjust the NCI. So automatically the balancing figure will be 80%. So we never apply percentage on any of the items of the income statement right from the revenue to the profit. Now let's start the new topic. How will the accounting entry for this? For what item you wanted me to show the accounting entry? Yeah, there is a MCQ and CRQ handout, but it will be shared tomorrow because the handout includes a mix of questions. So in these 2 days, we'll be focusing on first the topic, then I will share with you the for the disposal. If you wanted to know the accounting entry, the accounting entry for the parent will be cash debit, investment credit, 8 million, 6 million, and gain credit by. So this will be shown in the books of. With respect to the group, cash debit by 8 million, net assets credit by, we have net assets having a value of 7 million at the date of disposal. Goodwill will be credited by 1.2 million. NCI will be debited by 1.4 million, and there will be a gain which will be the balancing figure. It's 9.4 minus 7.2. Answer will be 1.2. Okay, I have shared the answers for the long questions, which has play. I think the name of the question is play, and one more question. I think it was sprints. So I've shared one balance sheet question and one income statement question. So I have shared the answers on the group, and I will share the answers of the MCQs by tomorrow. Mock test, or we have to do on the ACCA. Yeah, I will share with you guys the mock examination on the last day of my session. Okay, so let's start the working on day 3. So in section A and B, so these are the accounting standards from which examiner can ask you the question. It could be a question from the property, plant and equipment IS 16, intangible asset IS 38, impairment 36, taxation 12, financial instruments Government grant, borrowing cost, ISN, provision, IS 37, foreign currency 21, consolidation, inventories, and ratios. For section A and section B, examiner is open, so he can ask the question from any part of the syllabus, but usually it comes from the IFRSs. What is IP and BA? IP means investment property, IS 40, and BA means biological assets. So BA means biological assets, IS 41. So now, out of these standards, we have picked the most important and relevant for this attempt. The first one is IFRS 15, revenue from the contracts with the customers. IFRS 15 says all types of revenue should be recognized under five-step approach. The first one is identify the contract. Second thing is identify the separate performance obligation. Third, identify the transaction price. Fourth, determine the transaction price to each performance obligation. And recognize the revenue when the performance obligation is satisfied. These are the 5 steps through which we recognize all types of revenue, whether it has been earned by the service industry or manufacturing concern, or you're doing some trading business. So this will be the success story. Sorry. This will be the 5 points on the basis of which we recognize the revenue. So there are actually cases of IFRS 15 that comes in the examination. So the first element is related to the financing element. Financing element means in a revenue transaction, there might be situations when you will have to pay part of the payment, or when you will receive part of the payment in the future. So if you are giving the credit terms, the goods on the credit terms, which have a material impact on the time value of money, then you can say that this transaction involves the financing element. Like you're selling the goods for a period of assuming 1 week or 1 day or 5 days, so that's totally fine. That's not a case of financing element. But you are selling the goods on credit terms for a period of 1 year or 2 years or 3 years. Like some of the companies sold different non-current assets on installments. In that case, you need to apply the accounting treatment of IFRS 15, which says that whatever amount that you are paying in the future, first you need to calculate the present value of that amount. The present value will be recognized as the revenue for the goods, and the difference between the present and the future value will be recognized as your finance income. So actually, IFRS 15 says that whenever you are selling the goods, that includes the financing element, it has 2 types of revenue. The first one is the revenue from the sale of the goods, and the second one is related to the finance income. So these 2 items should be recognized separately. So now you guys are required to solve this question. So just remember this point, that you need to calculate the present value of the future cash flow. Okay, let's start solving this question. Road enters into contract with the customer to sell the equipment on 31st December 2001. The control of the equipment transfers to the customer on that date. The price states that the contract of 1 million and is due on 31st December 2003. So right now we are at 2001. So the payment will be made in 2003, means after 2002 and 3. So you need to calculate the present value, which is 1 million into 1 plus 0.1 power minus 3. Minus 2, sorry. So the present value of 1000 will be 0.826. So 826 is the amount of the revenue for the transfer of the equipment. And the difference between 1000 and 826 will be my finance income. Difference between 1000 and 826 will be the finance income. The finance income will be 174. So in the income statement, you will recognize the revenue of 826 immediately, and you need to recognize the revenue of finance income of the current year, that is 31st December 2002. So 20x1. So this will go in 20x1. For the second year, the amount will be 82.6. And for the third year, the amount will be 91 approximately. Where should we have to include the finance income? Finance income will be reported next, just before the finance cost. Yes, I'm suggesting you to do the rounding off of the data. Is it clear? No? How do you know the finance cost? It's not the finance cost, it's the finance income. Okay, finance income. No, we never do it on the straight line basis. This is called actuarial method. And the air 0, that's air 1 and air 2. So 20x1 is an air 0, It's 2263. So initially we have recorded the amount at 826. So for the first year, the amount will be unwind at 10%. It will be 82.6. The amount is now at 90 point something. 826, 908. So again, then we take the 10% income. It will become 90.9 approximately, equivalent to 91. Is it done? Finance income will be reported separately before the finance cost. Yeah. For the first year, the amount will be receivables debit and finance income credit with 80.6. So I want all of you guys to attempt this question. That is note number 1, when non. Please do attempt this question. Yes, is it done? Say that when on made a large sale for the goods on 1st July, which was also the date of the delivery. Under term of the agreement, the Venon company will receive the payment of 8 million on 30th June 2009. So you will receive 8 million after 1 year. So what you need to do is to record this transaction at the present value of the future cash flows, 8,000 into raised to the power minus 1. The relevant discount rate for this question is 8%, and they have already given us 0.9259. So 0.9259 is the value that you simply need to multiply. And then you will find the value of 8,000 multiplied by 0.9259. 7407. So revenue should be recorded at receivables debit and revenue credit by 7407. So this should be the original accounting entry. And from this transaction till the year end is 31st December. So from July to December, you need to record 6 months finance income, which will be recognized as the receivables debit and finance income credit. 7407 into 8% multiplied by 6 divided by 12, it will be 296. Is it clear? So that should be the overall treatment of this question. But as it says that they have already recognized the revenue of 4 million, so you need to adjust the revenue figure by 3,000. 3407. It's not the finance cost, it's the finance income. So on the present value of the future cash flows, you need to take 8%, and from July to December, it will be for the period of 6 months. So first take 8% of 7407 and then multiply it by 6 by 12, you will get the value of finance income for the 6 months. No. Can we deduct 4 million that is recognized and then calculate the present value? No. Your answer will be correct if the company has paid the 4 million in advance and the remaining amount in the future. Then you need to deduct 4 million from the 8 million amount and the remaining amount at the present value. So this treatment will be valid only when the payment was made in 2 installments. No, there are some students who are saying that 4,000 should be initially recorded and then we'll take the present value. It will only be possible when the question says that right now the company is paying, customer is paying 4,000 immediately and 4,000 after 1 year. Then this will be recorded at present value and this amount at the full amount. Yes, the revenue should be adjusted by 3407. The discount factor will always be given to you in the examination, because if the discount factor was not given, the answer of each student will be different because of the rounding of the difference, rounding off fact. Yes, receivables and the revenue both will be adjusted with the difference of 3407. Is it clear now? So the next part is related to a bundle transaction in which you will be having goods and services in the same price. Suppose we are selling the goods at a value of 100 and selling the goods at a services at a value of 200. So the weightage of these two will be 300. So the percentage of the goods out of 300 will be 33% and the services will be 67%. So if the company is selling the goods and the services both at a reduced price of, say for example, $200, then this is called a bundle transaction. So you need to break down the value of the goods and services out of this 200 figure. So 33% will be the value of the goods and 67% will be the value of services. Why we are breaking these figures? Because of the fact that the revenue of related to the goods will be recognized immediately and the revenue related to the services will only be recognized when we deliver that service. So if we didn't deliver the service, then you need to recognize the portion of the service that you have delivered. Say for example, the value of the services is 100 and it is for a period of 3 years. So for each year, you need to recognize the revenue of 33.33. So the value of the services can be recognized over a time period. These are not ancillary services. Yes, at a point in time for the goods and over the period of time for the services. So you have this question in which you are required to calculate the price for the goods and the services. How should the transaction price be allocated between the machinery and the technical support? Please solve it. should sell the machine and 1 year's free technical support for 1,20,000 rupees. So right now the current price is 1,20,000, but does not it usually sells the machine for 1,20,000, but does not sell the technical support for this machine as a standalone product. Other support services are offered by the shed to attract a markup of 50%. It is expected that the technical support will cost 20,000. So first you need to calculate the selling price of the machine, which is 1,20,000. And for the services, we have been given a cost of 20,000 including the markup. So 20,000 divided by 100 multiplied by 150 will be 30,000. The answer will be 1,50,000. Now you need to take the percentage of these two items divided by 150. So it will be 80% for the machine and 20% for the technical support. So when you allocate the price, 80% will be allocated here for the machine. So out of 1,20,000, 80% is the value of the machine, which is 96. And technical support is 24. 20,000 is the cost that was given to us, and we have calculated the sales price of the service. So we have extrapolated the sales price from the cost price. The cost price is 100% and the sales value will be 150%. You can divide 120 by 150, you will get 80% for the machine, and by dividing 30 by 150, you get 20% for the services. Is it done? The next part. Why not 20,000 stated for the technical support? We cannot take 20,000 because we are talking about the revenue, and 20,000 is the cost of the technical support. And still confused with calculating 30,000. That's not a big issue. The cost, revenue, and the profit. When we talk about the markup, the cost will be 100%, profit is 50%, the sales value will be 150%. So we have been given the cost of this technical support. You need to calculate the sales value. So first you need to divide 20,000 by 100 and multiply it by 150. You will get the value of the service, that is 30,000. So 20,000 divided by 100 multiplied by 150. It's a simple markup margin concept through which we have calculated the value of sales. So we need to take this 30,000 as a sales value because of the fact that we cannot take the cost price in with the revenue. Okay. So moving on towards the next part, that is related to the construction contract. For all the construction contract, first you need to see the total revenue of the contract, then total cost of the contract, and then you will calculate the total profit or total loss for the contract. Sometimes there might be a profit making contract or loss making contract. So if you have been given a profit making contract, then it should be recognized proportionately, which could be based on work certified approach or cost based approach. Work certified approach means work certified to date divided by total revenue. So in the work certified approach, we calculate the percentage completion of the project with reference to the revenue. In the cost based approach, we calculate the percentage with reference to the total cost. So if my contract is 50% completed, then you can recognize 50% of the revenue, 50% cost, 50% profit. So these types of contracts will be recognized proportionately. But if it is a loss making contract, then full loss should be recognized in year one. So for all the contracts, first you need to calculate the total revenue, total cost of the project, and total profit. And then you need to see the approach to which you need to calculate the percentage completion. And based on the percentage completion, you can recognize the revenue, cost of sales, and gross profit in the income statement. So I want all of you guys to please solve this question. You have 1 minute for this. Yes, is it done? The total price of the contract is 5 lakh. Total cost will be 4 lakh, and the total profit will be 1 lakh. The stage of the completion may be estimated either using the cost value or the sales value. So for first, you need to solve it using the cost approach. So for with reference to the cost approach, the percentage will be calculated as cost incurred to date divided by total cost. So it will be 75%. With reference to the work certified approach, work certified to date is 4 lakh out of 5 lakh. That is 80%. So if we are applying the cost method, revenue will be 75% of 5 lakh. Cost will be 75%. Profit will be 75%. Revenue will be 75%. But if you are following the work certified approach, revenue will be 80%, profit will be 80%, the cost will be 80%. I hope it's clear to all of you now. Why we are getting these are actually different methods. So when you are applying the different methods, you will get the different percentages. Is it clear? Please do solve this question. Okay, let's solve this question. In this question, the total revenue of the contract is 30 million. Total cost will be 14 million they have incurred, and estimated cost of completion is 7 million. So the amount will be 21. So the total profit will be 9 million. So they are saying that the company is measuring the percentage completion based on the input method, means calculator using the input method means cost incurred to date, which is 14 million divided by total contract cost. So 14 divided by 21, we got multiplied by 100. So it will be roughly 67%. So now you can recognize 67% of the revenue, 67% of the cost. So it will be 20, and the 67% of the profit will be 6. So this will be recognized in the income statement. Is it done? Very good. Now with respect to the balance sheet, cost to date plus profit that you have earned till date less progress billing, the amount that you have charged to the customer. This will be recognized as a contract asset. This will be recognized as a contract asset. So if the value is negative, it will be recognized as a liability. So please calculate the balance sheet impact for this question. In the income statement, 20 million will be added in the revenue, 14 million in cost of sales, and 6 million automatically be adjusted in the profit. But with respect to the balance sheet, first you need to take the cost incurred to date. Cost incurred to date is 14 million, plus the profit that we have earned till date is 6 million, and the progress billing is 12 million. So my contract asset will be 8 million. Is it done? Now you guys are required to solve this part of the question. This one. The name of the question is Duggan. Note number 1. Note number 1 of this question. I'm making it a little bit visible for you guys. Please solve. And your requirement is to identify the impact shown in the income statement only. Not for the balance sheet, only the income statement. Note 1. Balance sheet. 21 to 60. Now, solving this question, that is note number one. Enter into contract with the performance obligation is satisfied over time. The total price of the contract is 9 million. Total expected cost is 5 million. So the total revenue is 9 million. Total cost is 5 million. Total profit will be 4 million. Now they have calculated the percentage completion, 50% for the first year and 80% for the second year. So 50% was done in first year and 80% for the second year. So remember this point, that whenever we have got the second year, this percentage reflects the cumulative percentage of 2 years. So if we effectively see that what percentage of the work that you have performed in year 2 only, so it will be 30%, because till year 2 your percentage is 80%, and you have done 50% of the work in year 1, so the remaining 30% in year 2, and you will break the figures on the basis of this: 2.7, 2.5, 1.5, 2, and is it clear now? Then we have a similar type of question with the name Haverford note number 2. Haverford note number 2. This is one of the important 80% means 80% is a cumulative figure for the 2 years. So for the second year only, you have worked additionally 30%. How to adjust in P&L? So in the current year, you simply need to add 2.7 million in the revenue and 1.5 million in the cost. So there will be an impact of 1.2 in the profit. So first 50% in year 1, and this includes previous year's percentage. So it says that 80% of the work was completed by the end of year 2. That includes year 1. So in year 2 alone, you have worked additionally 30%. That becomes 80% in total. Haverford note number 2. Okay, is it done? Note number 2. Very good. Haverford entered into a contract an asset for a customer satisfying the performance obligation over time. The contract is for a period of 14 months. Cost to date is 1.9 million and the estimated cost to complete will be 7.1. The total revenue for this contract is 14 million. Total cost will be 9 million. Total profit will be 5 million. Percentage completion is 40%. So it's very simple to recognize 40% profit, 40% cost, and 40% revenue in the income statement. In the balance sheet, you need to show the cost incurred to date, which is 1.9 million plus profit that you have earned to date minus progress billing. Progress billing will be 1.4. So the answer will be 2.5 contract asset. Now you don't need to increase the receivables, only the revenue will be increased, the cost and the profit figure, because it will be adjusted in the contract asset. Current assets, yes, contract assets should be reported under current assets. Actually, based on the work done, the cost should be 3.6 million, but out of which you have incurred 1.9 million. Cost to date in full. While we are calculating the overall profit of the contract, first you need to take the total revenue, total cost, and then total profit, and then you can apply the percentages. How do you get 1.9 million cost? 1.9 million cost is given in the question, that 1.9 million is incurred up till date, and remaining 7.1 million is the estimated cost to complete the contract. So this one is similar to the previous concept, that is bundle transaction, in which you need to separate the value of the goods and services. So we are not discussing this again. Sale or return basis. If the company has sold the goods on the agreement of sale or return basis, then you need to reverse the amount simply that you have previously recognized in the income statement if the customer has not yet confirmed to you that whether they are going to buy the goods or not. So if the company has previously recognized some revenue and the customer has not yet informed whether they are going to buy the product or not, then you need to reverse the transaction. So the accounting entry should be sales debit and receivables credit, and the closing inventory should be adjusted with this. This is the concept of sale or return basis. So first you need to reverse the sales transaction, No, we don't. We haven't received any cash yet, so it's not been recorded as a liability. Sale and repurchase agreement. In this arrangement, we are going to make a sales and then we will repurchase these products in the future. The accounting says that this is not a sale transaction, so you need to record the liability in place of the sales. So whatever amount the company has recorded for the sales should be transferred to the liability, and then you need to adjust the closing stock as well as you need to book the finance cost of this liability. Yes, so stock will be increased with the cost of these items. This is the concept of sale and repurchase agreement. So the basic theme is you need to add back the closing stock and reverse the sales transaction and record the liability in place of the sales transaction. What to do with the finance cost? Actually, we are considering the sale and lease back arrangement as that we have borrowed a loan. So if you have borrowed a loan, then you need to record the finance cost of the loan as well. It can appear in the current or non-current liability, depends on the time period of the liability. Can you explain the closing stock? Actually, in these two transactions, the sale and repurchase and sale or return basis, we are assuming that the transaction of the sales has not taken place. So if the transaction has not taken place, then that means the stock is still held by us and it's not yet been sold. So you need to adjust the closing stock because these inventories are not had been yet to be sold. So here we have got the 12 million of the amount. So 12 million will be recognized as sales. So you need to add back or reverse the sales figure and recognize the liability in place of this. Commission sales means that you are working as a commission agent on the behalf of a principal company and you work on the basis of the commission like 10%. So if you made a sales of the principal company as 1 lakh, your commission will be 10,000. So the basic concept is that you can only recognize your commission income, but you cannot recognize the revenue of your principal company. Revenue is related to the principal company. Being an agent, you can only recognize the commission as your income. So these are the adjustments in which the examiner will give you the situation in which the company has recognized the sales of the principal company. So all you need to do is to reverse the transaction. Hello, hello. The voice is clear now? Okay, then fine. Thank you. So, what are my last golden words before my voice was gone? Can you tell me what we were discussing and where were you? Okay, from the beginning of the question, it says that Rosemary revenue includes 2 million. The company has recognized 2 million as a revenue, which for the goods it sold, acting as an agent. So you are working as an agent of another company, Elaine, but you have recognized the full amount of the sales. But you are only entitled to record 20%, which is your commission, which is 0.4 million. So your share of the revenue is 0.4 million, but you have recognized 2 million into your books. So what you are required to do is to reverse 1.6 million from your books. So the accounting entry will be revenue debit by 1.6 million and cost of goods sold credit by 1.6 million. Is it clear? Remitted means that you have transferred the funds because we have received the amount on the behalf of our principal company, and you need to to pay the amount to the principal company after deducting your commission. So the first thing that you need to do is to reverse the revenue and then the corresponding entry. Yes. JV of 0.4 million commission earned, and it's statement in Rosemary. Rosemary can only recognize the revenue of 0.4 million. The accounting entry will be cash debit and commission income credit. Is it clear now? Credit will be cost of goods sold. So what if 1.6 million is not in cost of goods sold? If the 1.6 million is not in cost of goods sold, then you need to see that where the company has charged this 1.6 amount. So wherever the account, whichever account is used will be reversed because of the fact that this is not our cost of 1.6 million. They are showing to the world that we are purchasing the goods for 1.6 million and selling it for 2 million and recognize a profit of 0.4 million. My voice is clear or it's lagging? Clear voice? Okay. So what about this concept? Is it clear to all of you guys? Okay, then. Now we are taking a break, short break of 10 to 15 minutes, and then we'll start after the break. Okay, welcome back after the break. Let's start with the topic financial instruments. Financial instruments, a contract that give rise to the financial asset of one entity or financial liability or equity instrument of another entity. So these are actually contracts which creates financial assets and financial liability or equity instrument at the same time. So we have studied previously about the assets, but there are certain assets that are called financial assets. So what are the assets which we call financial asset? The first one is the cash. Equity instrument of another entity means the ordinary shares of another company. Contractual right to receive cash or another financial asset, and the contractual right to exchange assets which are favorable. So these are the four definitions of financial assets. In this definition, we can take an example of debtors and loan assets. Financial liability is the contractual obligation to deliver cash or another financial asset or exchange of financial instruments which are potentially unfavorable. Okay. Talking about the financial liability can be measured at amortized cost, and financial asset includes debt instrument and equity investments. Financial liabilities can be measured at amortized cost or fair value through P&L category. This category will only be used when there is a held for trading liability. So if you have got a held for trading financial liability, then it should be measured at fair value through P&L. Otherwise, all type of financial liability should be measured at amortized cost. There's a concept of compound instruments. That means the instrument includes the equity and the liability component both. So you need to separate the liability and the equity and record liability and equity separately. Equity investments can be measured at fair value through P&L and fair value through OCI. If you wanted to hold for the long term, then we use the head fair value through OCI. And if you wanted to use for the short term, then fair value through P&L will be used usually. In this case, transaction cost will be recognized as an expense. In this case, the transaction cost will be capitalized in the value of the asset. And this option is irrevocable. That means if you have exercised this option, you cannot change the equity instrument category from fair value through OCI to fair value through P&L. Is there any fair value through OCI in the financial liabilities? No. There is a category of fair value through P&L and amortized costs. So the financial liability can be measured at fair value through P&L or OCI. With respect to debt instrument, we have amortized cost method. We have financial fair value through OCI category and fair value through P&L. So three categories for what will be treatment in long term. If the shares are held for long term, usually it will be measured at fair value through OCI, and the transaction cost will be capitalized added in the value of the asset. So for the debt instrument, that means that we have a loan asset. It's not a liability, it's a loan asset that you have given the loan to another party. That will be an investment, which could be measured at amortized cost, fair value through OCI, fair value through P&L. We add the transaction cost in all the cases of assets and deduct in all the cases of liabilities. First point. Second point is only in case of fair value through P&L category, the transaction cost will be recognized as an expense. In case of fair value through P&L category, is it done? For the debt instrument, we have got three categories: amortized cost, fair value through OCI, and fair value through P&L. For fair value through OCI and the amortized cost, you need to pass two tests. First one is the business model test, second one is the cash flow test. If your instrument will be able to pass these two tests, then you can measure it at amortized cost. And similarly, there is a test of fair value through OCI, business model, and cash flow. So if the test is passed for a particular category, then you can place it under that category. If the instrument fails to be placed in amortized cost and fair value through OCI, then it will be placed in fair value through P&L. Substance here in the slide. Substance means that there are some instruments on which you need to recognize whether it is a liability or the equity instrument. So how we can identify the liability or the equity instrument? In liability instruments, there will be an obligation to repay the amount, but in the equity instrument there will be no obligation. Like in the preference shares case, we have redeemable preference shares and irredeemable preference shares. We must know that there is an obligation to pay back the amount if the company has issued the redeemable preference shares. So this situation will be recognized as a liability, and if the shares are irredeemable in nature, means you don't have any obligation to pay back the amount, then it will be considered as an equity. So there is a clear cut instructions that how you can identify liability or the equity. For the liability component, you need to see that whether there is an obligation to pay back the amount or not. Next slide. It's about the simple loan. So whenever you have got the simple loan, all means it is a financial liability. All loans should be measured at amortized cost. So under amortized cost, first we take the obligation at start, which will be measured at the par value of the instrument, less issue cost and discount. Then you need to charge the interest, which should be based on the effective rate. Effective rate will always be given to you in all the cases. This rate will be applied on this value, and there will be a payment situation which will be based on par value of the instrument into the nominal rate of the loan, and then you will get the obligation at end. This obligation at end will be reported under non-current liability, and this amount will go in the finance cost. Discount means that whenever you are going to borrow the loan, you have given the discount to the company. Means like if the instrument has got the value of $100, you are issuing that instrument at a value of $60. So that means that you are giving the discount. So I want all of you guys to please solve this question based on the working that I have mentioned and calculate the amount that will go in the income statement and the balance sheet. WBCL, I didn't get you. Please calculate this amount. So let's solve it. Year 1, obligation at start will be 20,000 minus a discount of 2.5%. So 2.5% of 20,000 will be 500, and the issue cost is 534. So when we deduct 20,000 by 500 and 534, we got the value of 18,996, 966. That is my obligation at start. The interest will be based at 7%, which is the effective rate. 18,966 into 0.07. 1327 is my finance cost. The payment will be 800, and obligation at end should be 18,966 plus 1327 minus 800, 19493, which should be reported as a non-current liability, and this amount will go in the finance cost. Is it clear? Very good. Let's move on towards the next point. Now here we have got the compound instrument. So when we talk about the compound instrument, that includes equity plus liability both. So first you need to calculate the liability by taking the present value of the future cash flows, and the residual leftover amount will be the equity of this. And then when you separate the value of the equity and liability, where will the issue cost and the discount will go? The issue cost and the discount will be recognized and adjusted against the liability. That's why we have deducted the value initially from the loan. 18966 is calculated after deducting the issue cost and the discount. The issue cost of the loan is 534 and the discount amount is 2.5%, which is 500. 1327.62 to 1328. Yes, you can take 1328 directly. Okay. So now, how we can calculate the present value of the liability? So first you need to analyze the cash flows of the instrument, assuming it is a loan. So we have got a loan of 5,000. So on each year, this loan is repayable after 3 years. That's mentioned here. And for each year, you need to pay the interest of 25, 250 for the first year, 250 for the second year, and in the final year, you need to pay the capital amount plus interest. So these are the cash flows of the instrument. And we want to extract the loan amount from these cash flows. So you need to take the interest rate of the loan without conversion option. So we have to pick these values in order to calculate 0.93, 0.86, 0.79. So by multiplying these values, we got the value of PV of liability. So for the first year, the amount will be 250 into 0.93. It will be 232. For the second year, the amount will be 215. And for the third year, the amount will be 4147.5. So by adding these figures, we got the value of 5251, no, 49 4595. 4595. So if the value of the liability is 4595, then the residual amount will be the value of the equity. So you need to deduct 4595 from 5000. 5000 minus 4595. There is a value of 405 for the equity, which will be reported as equity option in the equity section of the balance sheet. So, so at the start of the issue of the loan, first you need to separate the value of equity and the liability, and after that this will be considered a simple loan which will be amortized like as normal. Year 1, obligation at start is 4595. Interest will be paid at 8%, and which is 4595. That will be 368. Payment is 250, and obligation at end will be 4595 plus 368 minus 250, 4713. So this will be my non-current liability. This is my finance cost that you need to charge in the income statement. So for the compound instrument, we have two steps. The first is to separate the value of the equity and liability, and then the liability will be amortized as normal. Equity option will be calculated as the total amount of the convertible loan minus present value of liability. Convertible loan is having a value of 5000 minus present value of the liability is 4595. So this is how we have calculated the value of the equity 405. No, you don't need to break the liability into current and non-current liability. This case will apply when you are talking about the leases. We will never don't mix up this is standard with IFRS 16. We can never pay the interest in advance. It was actually the treatment of leases where we have two cases that the installment can be paid in advance and in arrears. We will always pay the interest in arrears. There will be no situation of advance case. Is the convertible loan always the issue cost? No, no, no. There is no issue cost in this question. EO means equity options. Actually, when we have borrowed the loan, the normal accounting entry that we make, the normal accounting entry will be made for the issue of the loan is cash debit and loan credit, 5,000. IS 32 says that for the issue of the convertible loan, you cannot make this accounting entry because of the fact that this 5,000 loan includes equity and liability both. So the accounting entry should be cash debit by 5,000, liability and equity option. These two items should be credited. That is what we have calculated as 405 and 4595. So this amount will portion will remain constant over the period, and this will be amortized as normal liability in the future. That's what we have done this. Current liability is always 5,000. No, it's not a current liability. Where is the current liability? It's not current liability, it's convertible loan. And it's mentioned here that the company has issued a convertible loan of 5,000. So it will always be the amount of the loan. It's not current liability. Now please solve this part. Question number one. Haverford, note number one. Okay, first do note number 4 of the topic Dugan. Dugan is the name of the question, and you guys are required to attempt note number 4. Okay, yes, is it done? Do you guys want me to solve or it's done by all of you? Should I solve it? Yes, the equity amount is 180. So one of the students wants me to solve it. So first you need to see the amount of the loan. You can see here the amount of the loan is 5 million. So when we convert this value into thousands, it will be having 5,000 convertible loan. It has an interest rate of 6%. The time period is 2 years. So first you need to calculate the cash flows of year 1 and 2. The cash flows will be 5,000 into 6%, 300 for the first year and 5,300 for the second year. The discount factor that you need to follow will be the interest rate of the loan without conversion option. Here you can see there is a without conversion option was given to you. It is 8%. So 0.926 and 8.7. 0.926. So simply you need to multiply, you got the value of PV. So the total amount will be the PV of liability. So which is 4820. Am I right? No. PV of the liability will be 420. Okay. And the difference will be the equity option. The difference is 180. Approximately 4820. And then you need to measure the liability at amortized cost 4820. 8% payment will be made at the nominal rate, which is 300, and you will get the obligation at end. So what will be the interest amount? Interest amount will be 386. The obligation at end will be 4906. So this will go in the finance cost. Wonderful. So one more question for your practice, and then we'll move on towards the next part. Now attempt note number 3 of this question. Note number 3. Okay, for this question, when you start reading this question, it says that this question is related to financial asset because the company has acquired 9 million bonds. So this is not a financial liability. And the second evidence is you have an interest receivable. So what you need to do is to make the amortization table. So it is my financial asset. So the table will be year one, financial asset at start, then there will be a finance income, receipt, and financial asset at end. So we are now working here as an investor of this loan. So obligation at start will be 9,400. Interest will be paid at 8%. So 9,400 into 8% will be 752. So from 1st January to December, 12 months has gone. So 752 will be the, and the receipt is 450, and the financial asset at end will be 97042. So this is not the case of financial liability, it's actually a case of financial asset. So in case of financial assets, the issue cost should be capitalized, and in case of financial liabilities, the issue cost should be deducted from the initial obligation. Where we have to include the balance of 970. 9702 will be reported in non-current asset with the name financial asset. 752 is my finance income. Here we are providing the loan to someone, so it's our financial asset. It's not a liability case. If you borrowed the loan, then you have to pay the finance cost. But you are giving the loan to someone, then it will be your finance income. Yeah, if it is a financial liability, then we need to deduct the issue cost, which is the broker fee. Should not add the payments. No, the payment will be deducted because whenever you have received the investment back, that will decrease your overall investment. Why did you add the expense in the bond? I think you joined the class late. I'm repeating the point again that there might be a case of financial asset or financial liability. If the company has issued or borrowed a loan, then obligation at start will be measured at the par value of the loan less issue cost and discount. And if this is the case of a financial asset, then the loan asset will be recognized initially at the par value plus the issue cost. Or you can say this as a transaction cost. So the transaction cost should be capitalized for all the financial assets, and it should be deducted for all the financial liabilities, and it will be recognized as an expense in case of fair value through P&L. So because of the time limitation, I will not be able to go into more detail and to discuss about the concepts of this thing, but we have to follow these rules. Yeah, as they have already recognized an amount of 450 in the income statement, therefore you need to adjust 302. Is it clear, guys? So whenever you are going to read the question, it's very important to see whether the company, now the wording is the well-known company acquired 9 million. Now what about this one? Company issued 80,000. It's my liability. Company issued 5 million convertible loan. It is my liability. So whenever we are going to issue the instruments, that means that we are borrowing the funds against the instrument, that is my financial liability. But when we are going to acquire the bond, that means that we are going to invest in the bonds, that is my financial asset. I hope these points are clear to you guys. So it's already discussed. So please attempt this MCQ from the exam point of view. Yes, the right answer for this question is it should be A. The right answer is A. Is it clear? You don't need to deduct the selling cost, only it should be accounted for at the fair value. So is it done? The right answer is A. Now, there's the concept of factoring under IFRS 9. Is 7.25 into 5,000, 9,000. That means that you are selling your data to the third parties. So the risk of bad debt is either transferred from the company to the factoring company or is still beared by the factoring company will be depend on the arrangements. So there are two types of arrangements. The first one is called with recourse and second one is called without recourse. Without recourse means the risk of the bad debts will be beared by the factoring company. And with recourse means the risk of the bad debt will be beared by the company itself. So whenever you receive the upfront payment from the factoring company, then you need to record this transaction by debiting the cash and crediting the receivables. So this is a normal treatment as we normally do when we receive the cash from the customers. But whenever the case is for the with recourse, means the risk of the bad debt will still be beared by the company. That means that whatever cash that you receive from the factoring company will be recognized as a loan. And whenever you have recorded the loan, you need to book the finance cost as well. So the difference between these two is the receivables de-recognized. Means you can credit the receivable figure in without recourse arrangement. And it says the receivables not de-recognized. In this situation, you not de-recognize receivables. So the whole amount will be recognized as a loan. So in the examination question, you only need to see who is going to bear the risk of the bad debt. So if the bad debt it will be borne by the company, then whatever upfront payment that you have received from the customer will be recognized as a loan. And if the bad debt will be borne by the factoring company, then the whole amount will be deducted as the payment received from the customers. Is it clear now? That's the treatment of the factoring arrangement. So today we have covered two key accounting standards along with the disposal concept, that is IAS 32 and IFRS 15. I request all of you guys to do maximum practice of these two standards by tomorrow, and tomorrow we'll be discussing on the more important and most important standards for the final accounts. Today we have discussed the disposal concept, IFRS 15 and IAS 32. along with IFRS 9. So I think the time is over now. So tomorrow we will start with uh, deferred taxation. We'll have to do some adjustment of the deferred tax. Then we'll move on towards non-current assets. That includes IS 23, IS 20, government grant, IS 16, and IFRS 5, along with the adjustments of IS 36. So till tomorrow, you are required to do some practice of the MCQs of the related standards that we have covered. So from my side, the consolidation is done. So you have to do at least 3 questions on the balance sheet and 3 questions for the income statement for the consolidation, and at least do all the MCQs related to the consolidation from the examination kits, both Kaplan and BPP. Thank you so much for today, and we will start the class for tomorrow at the same time. To take care of yourself and do as maximum practice as you can. I'm sharing the video lectures of day 1, and I have shared the video lecture of day 1 and day 2 on the group as well. So you can see the lectures as many times to improve your concepts. Thank you so much. Allah Hafiz.